I think this could be really good. I mean, if they could build over the next 10 or 20 years a second company that is as successful as Quicken, well, that would be pretty good for Detroit.
That's the voice of Erik Gordon, a professor at the University of Michigan's Ross School of Business.
Today's episode dives into Dan Gilbert's Quicken Loans, or rocket companies as they're going to be called moving forward, filing for an initial public offering on the New York Stock Exchange.
It's not all that often that this happens here in Metro Detroit, so we wanted to dive in with an expert to understand the ramifications for both the company and Detroit, the city. And we'll unpack it with a couple of our own thoughts afterward.
This is your Daily Detroit for Monday, July 20th, 2020. I'm Jer Stays.
And I'm Sven Gustafson. Let's just get to it. Professor Gordon, welcome to Daily Detroit.
Oh, I'm glad to be here.
So Bedrock didn't really specify its goals, but what would be the reasons for a company like Bedrock to go public? I mean, this is a company that we found out, thanks to its SEC filings, earned $894 million in 2019, which seems like things are going pretty good for them.
Yeah, they don't have to go public. They're not desperate for money the way a lot of these little biotech companies that try to go public. They go public because they're running out of money and they need the cash. Bedrock certainly doesn't need the cash today. You go public for a couple of other reasons. One is to make it easier to get cash in the future when you might need it. And I think all of the COVID/economic uncertainty has led a lot of companies that don't need cash today to do something to either pile up cash that they can't possibly spend in the next year, just to have it on hand, or to make sure they have access to cash if they might need it in the future. And, if you think back to the financial crisis, you can understand why Bedrock or any of these other companies would do it. Because during the financial crisis, great companies that used to have banks begging them, oh, let us lend you some money, couldn't get their hands on 10 cents. Liquidity froze. I think a lot of companies learned their lesson. So I think Bedrock is doing something safe, looking towards the future. And then there's the question of flexibility and liquidity for Dan Gilbert. He holds a lot of assets that are not liquid. This could be a step towards more liquidity for Dan and his family.
Mm-hmm. When you say that Dan Gilbert owns many non-liquid assets, for example?
Well, this was one before it went public. This is not liquid. His real estate assets are not particularly liquid. You can't sell real estate or a lot of it quickly. He has a lot of real estate, located in one city. So he has a lot of wealth. I guess you could probably sell the Cavaliers pretty quickly. There'd be a line to buy even the Cavs. Mm-hmm. My guess is that Dan's advisors have been whispering in his ear for quite some time. Looking forward, you need to think about liquidity. And, his more recent health incident may have made him listen a little bit more carefully to them.
Well, one of the things that I wanted to explore with that, because covering his real estate, one of the problems he sometimes faced is that even he has trouble accessing lines of credit for his projects. And a lot of things he's had to self-finance and then offload to banks and the like once, it's already built or it's already leased up to a point. And I know that that's something that's been a little bit challenging with doing his projects, whereas in a lot of other cities, you kind of can arrange financiers in different ways before you get started. With Dan's Detroit work, a lot of it has been, cash over the barrelhead, and it's been his money doing it.
Yeah, that's the Detroit effect. Real estate projects like the ones Dan does, not a slam dunk in Detroit. Detroit is still seen as a very risky place to invest in real estate, which makes what Dan has done in Detroit and his commitment to Detroit all the more remarkable because, as you said, if you were building in, pre-COVID, if you were building in New York or Chicago or Los Angeles, the banks are falling all over themselves to lend you 102% of the value of the building. as opposed to Dan having to go out on the line until he can show that the building can be leased up. So, a brave guy, kind of the only kind of person who could succeed in Detroit real estate.
So the proposed IPO would give Dan Gilbert, speaking of which, 79% of the combined voting power of the common stock. Is that common for a company founder to write in a provision like that? And why is that significant?
Yeah, it has been surprisingly common in the last decade, and it has given rise to some controversy. So, sometimes it's turned out great, and sometimes it's turned out terribly. Think about when Travis Kalanick was in control of Uber. That didn't end well.
Mm-hmm.
Adam Neumann at WeWork didn't end well, but sometimes it ends really well. Think of the Google guys. They were in control. Bezos in control. This idea of you go public but keep control, or if you're an investor, you're on the other side of the table. You buy stock in a public company and you have no control. The founder still has control. You have to have a lot of confidence in the founder's abilities and that the founder doesn't turn out to be, some kind of Looney Tunes sort of guy.
How will going public change the company? I mean, actually, we're talking about several companies here, obviously, and how they do business.
Yeah, so they put Quicken, the big company, Quicken Loans, into it. And then this whole grab bag of companies that are related to the business that Quicken does. And there'll be a couple of changes. One, they're going to have to reveal the finances and a lot of other details in ways they never had to do.
Mm-hmm.
Every quarter, they're going to file extensive reports with the SEC and an even longer one once a year. And, you and I and all of your listeners can go on the web and look that up. And it'll include things including people's salaries.
Mm-hmm.
So they'll be revealing a lot of information that they were able to keep private. They'll be under a lot more scrutiny. They're going to spend a lot of money on being a public company because the kinds of audits, the kinds of legal fees that you end up paying, $1 million+ a year. So it's a new expense that they didn't bear. But I think the big thing in this case is, they're going to lose their privacy because Dan is keeping control, as you mentioned, 79%, which is really total control. They're not giving up control. But, when you're a private company, you enjoy being private.
Yeah, and that definitely gives you some specific advantages, dealing with your competition, dealing with, the kinds of projects that you're working on. For me, one of the questions that I look at when I went through the documents is it's clear to me that they're really looking to expand their lines of business in a major way. This isn't just to throw out more home loans out there. It seems like they've got some what seem like nascent lines of business now, but could be really big deals.
Yeah, this is a long-term play, which of course is how, Dan thinks. I mean, all of his real estate plays are long-term plays. Quicken isn't this overnight thing where, 3 years ago it was valued at $1 million, some of the silly stuff we see. I mean, it's been around for 30 or 35 years. And they really dominate the home loan business. They are number one. So when they're looking at expansion, they're doing, what I teach my students in a strategy course. You say, wow, well, look, we're number one in home loans. How do we use that to build ancillary businesses? Businesses where our strength in the home loan business, our reach in the home loan business, give us an advantage, and let's build some other big businesses. And that's what they're up to. Clearly, they're long-term thinkers. They're investing in the future. They've asked themselves the question of what happens when we have so much market share in home loans that it's no longer a growth rocket. What's our next rocket? They're clearly all over that.
So thinking about this pressure to always be growing, to be focused on the next quarter and the financial results and delivering returns to investors, what's that going to mean for the 20,000 employees at these bedrock companies? Many of them, frankly, are listeners of our show.
So I think they're going to see very little change, except maybe a beneficial one. Here's why I think they're not going to be too affected by those typical public company pressures where management makes decisions which optimize the short term so that they get to keep their job and kind of toss out the long term. And then when they hit two bad quarters in a row, the top brass save their jobs by firing everybody else and saying, oh, look, here's my turnaround plan. I'm firing everybody who's not me. I don't think people at Rocket, at Quicken, need to worry about that because Dan's not worried about losing his job. The top management aren't worried about losing their jobs. An activist investor can't show up and rattle their cages and scare them and get them thrown out because Dan has control. So the fact that Dan has kept control and has been the guy who's had control all along means I think the employees should expect pretty much the same that they've seen in the past, but with one possible upside. Some of them could actually get stock options now and be paid in stock and participate in the upside equity of the company in a way that wasn't possible when it was private. So, if I were working at Quicken, I would think, oh, this might be pretty good.
Yeah, I have a thought along those lines. We talked about the employees, but what about the city in general? You look at cities like Charlotte that have been able to grow at insane paces due to the financial sector, and seeing a company like Quicken, or what I guess they're officially wanting to be called now, like Rocket or Rock, seeing this kind of move looks like an expansion of those services and maybe even expansion of things that could be offered here in Detroit. I think for Detroit's comeback to be sustainable, we need more than just one superstar company. And how could this impact the city long term?
Well, this could be great because, we haven't been successful at attracting big businesses to come in. Years ago, Chicago attracted Boeing's headquarters from Seattle. We haven't had much luck with that. So, what you have to hope is that companies like, I'm going to keep calling it Quicken because I've always called it Quicken, that companies like Quicken, one, stay headquartered here, don't move to Texas or anywhere else, and that they keep growing. So the fact that they have given us a peek at what their thoughts about growth are, and the fact that at least I think those thoughts make a lot of sense, I think this could be really good. I mean, if they could build over the next 10 or 20 years a second company that is as successful as Quicken, well, that would be pretty good for Detroit.
And do you expect that, some of Dan Gilbert's sort of side work, that is to say some of the things that are not central to the, business of Quicken Loans, all of his real estate, and, I think they're still involved in some venture capital activities and things like that, that those are going to be affected, pro or con, from this IPO?
I think those things will continue forward. I mean, I knew Matt Cullen, who was running the real estate side, and that's really inside Dan's heart. He's not going to stop doing that. And, Jake Cohen and others at Detroit Venture Partners at the venture arm, they've built a good team. Jake's one of my former students. And Dan's heart's really in that too. I mean, this is the entrepreneur's entrepreneur. So I think we won't see any changes there. You'll worry about when a company goes through a change like going public, will they still be able to be involved civically? Well, Dan was in control. He's still in control. Public companies can be as involved civically as they want to. When I was a little kid, I lived in Midland, Michigan, and Dow Chemical Company is a public company, and it was very involved and good to the community. So the fact that one piece of his business, a big piece of his business, has gone public doesn't mean we should worry about any changes on the downside.
You've presented a very optimistic view of, this whole move to going public and everything. I wonder, do you see any big risks for Bedrock?
The risks when you go public is the litigation risk. When you're a private company, you're owned by a very small group of people. There are only a few people who can get angry, and you typically work it out. When you go public, any of your thousands or tens of thousands or hundreds of thousands of shareholders can sue you. And in fact, there's a whole group of lawyers, the plaintiff's securities law bar, cruising around. And if you have a disappointing quarter, they can't get anybody fired, but what they can do is file lawsuits claiming some kind of securities fraud. So public companies spend even the best up and up public companies just regularly spend money swatting down these nuisance lawsuits. So, that's an annoyance. I don't know that it's really going to be a danger, but everybody will have a down quarter or two, and you can be sure somebody will convince somebody to bring a suit and sue them. So, that's just unavoidable.
Well, I was going to ask about one of the other companies that is in this kind of their whole like umbrella and family of companies, StockX. That's been, a unicorn that's gotten a ton of press and a ton of traffic and a ton of attention. Do you think a successful IPO here could portend well for other companies in this group, or does that not affect it? Or what do you think around that?
Yeah, it could happen. I mean, took 30 or 35 years to take Quicken public, but for StockX or something else which could be spun out as public, I think if the experience for management and for Dan is positive, if he isn't too aggravated by now having a public company, yeah, we could see one of the other successful growth engines also spin out as a public company.
What is your sense, finally, of the kind of response this IPO is likely to trigger from Wall Street? Do you think it'll be successful? And is it all noteworthy that this IPO will, we don't know exactly when it's going to happen, but presumably it's going to come during the coronavirus pandemic, which has obviously, shut down huge swaths of the economy?
Yeah, and you have to wonder, what it's doing for home loans. I don't really know whether it's affected home loans. Some people might be refinancing houses. To predict how an IPO will do, which I often try to do, I actually try to predict it, and it's really hard because there are two factors. There are the factors that the company controls, and then there's the market stuff, what's going on in the market. Some other loan company, some other insurance company reports bad results, and all of a sudden, people are worried about you, or coronavirus cases go up, or something happens with China. So there are all of these things under nobody's control and which are unpredictable. They're like hazardous things falling on your head, make it tough to predict. The part where analysts will look at the company, that part's going to go very well because this is not a speculative company. This isn't a company where its entire value depends on this drug that they haven't proven does anything. It isn't dependent on them proving that it does cure cancer, which won't happen for the next 4 or 5 years. And if they can't prove that, the company is worth zero. It isn't one of these platform companies where they make more and more revenue and twice as much more losses. This is just a really solid, long-term, profitable company. So when analysts look at it, and when investors at pension funds and insurance companies, big investors who buy big amounts of the stock, look at it, they're going to say, wow, this one looks good because there's upside, there's growth, there's a growth story. It's not run by a 28-year-old egomaniac. Long history, trust management. I think for whatever's under the control of the company, it's going to go really well.
All right, fascinating stuff. Erik Gordon is professor at the University of Michigan Ross School of Business. Professor, thank you so much for your time today. We really appreciate it.
It was my pleasure.
That was a great conversation, Sven. I'm really glad that we had it, but it just, I don't know about you, but it gives me a lot of thinks.
Yeah, I would say that Professor Gordon certainly offered a very upbeat assessment of the situation. I think, he justified his arguments very well. I'm going to just kind of play a little bit of devil's advocate here in a way. And let me qualify by saying that I've never worked for a publicly traded company, but I've certainly read a lot of stories about publicly traded companies and sort of, some of their internal machinations and everything. And there is no doubt that once you go public and, you get investors, who own stocks and everything, that there's going to be enormous pressure to hit quarterly topics, right? Like the short term becomes in many times more important than sort of longer term goals. You hear stories all the time about publicly traded companies, these frantic emails from company leadership to all employees, trying to rally the troops because we're in danger of not missing our targets for, our upcoming first quarter reports and everything like that. I will say that Quicken Loans, which is sort of the biggest piece of this family companies, has really been known as a place, at least in certain departments around the organization. There's been a lot of churn. People have kind of cycled in and out of there relatively quickly. There's certain departments always seem to be hiring because they, just don't seem to be able to keep people for very long for whatever reason. And I can't help but wonder if that is a trend that we'll see increasing as a result of this. That said, as far as I know, and correct me if I'm wrong, Jared, but I'm not aware of any like mass layoffs that have taken place inside, the Quicken Loans family of companies in recent years. Despite the churn, they're not eliminating positions. It's just people quitting and then they, hire new people to take their place. But the overall employment levels seem to be pretty stable. Going public, if they inevitably miss a quarter or two of, stockholder and analyst expectations, that could change that.
Well, from multiple conversations, there are parts of the empire there, the Quicken empire, that are pretty high pressure situations where it's the churn comes from, high performance in short times, needing to make numbers, that kind of thing. That's just kind of the culture in a lot of mortgage-based businesses in finance. You've got targets to hit and all that kind of stuff. Mm-hmm. That said, I see what the professor was saying around the leadership being stable, but my thoughts are once you start getting stock options into the mix, you might have a culture where the people at the top might be secure and feeling safe, but people down below, they might be, when you start looking at things that have a stock target, if you look at your own stock and seeing the stock go up or down depending on performance, that I've seen that impact people's decisions. I've not worked for a public company before, but I have worked with companies who have on a very regular basis and interacted with them. And it is interesting to see how people's decisions start to change when they start to get fixated on that stock number. So I don't think it'll necessarily impact the people at the top, but your middle and below, people just can't help but look at that stock price number. They just become fixated on it. But my thought on this one, Sven, is a little different, and it is more on the civic side with this whole thing. Mm-hmm. One of the things I've mentioned on this podcast before is that I don't think Detroit really knows what growth looks like. If you think about places like Charlotte, you think about places in the West and the Southwest, well, outside of Corona times, the population growth is insane. And we don't know what that kind of investment growth, that kind of thing, things that are normal in other cities feel like hyper fast right here because of the big void. And I caught on something that the professor talked about was the idea that what if this empire doubles? What if the business doubles?
Yeah.
What does that footprint look like? Think about how much change has been in the city now, and then you double that, or even let's say they hit 50% of that. That's huge. That's a large amount of construction that would need to be done. That's a large influx of residents, all that kind of stuff. And then you got the spin-off businesses. You start having people who used to work there start businesses of their own. And you have vendors and things like that. It just changes the landscape of, that corner of the city even more.
Yeah, and I think it's key too, and we talked about it with Professor Gordon, the 79% control of voting that Dan Gilbert has secured, I think is key. And I don't remember if it was the Free Press or the News, but they wrote about how this is essentially a hedge. Maybe they even spelled it out in the SEC documents. I don't remember, but it's a hedge against any efforts to, essentially get the rocket companies to relocate outside of Detroit, as a lot of investors will probably want to do, because they look at Detroit and they just think it's, sort of outmoded and it's just an old, industrial economy sort of mindset. You talked about that a lot with Rivian, and that was frankly something we saw several years ago, remember, with CompuWare investors.
Oh yeah, as soon as CompuWare lost local control, they were out.
Yeah, I mean they faced a huge backlash from an activist investor who thought that the company was being mismanaged and needed to move out of Detroit, and I mean CompuWare really doesn't exist in name anymore. I don't even know It's under some other names now, but it's a shell of its former self.
Well, that's all for today's show. Thanks to our members, including Emily, Lindsay, Catherine, Christopher, Ben, Lynn, and Alastair for supporting your Daily Detroit. By the way, we now have a button right on the front page at dailydetroit.com. That links to patreon.com/dailydetroit, where you can become a member.
We're also considering custom Detroit-made masks as a member reward. They would say something like Daily Detroit. They'd have our beautiful shield logo. Interested in that? Let us know. Email us at dailydetroit@gmail.com.
With that, I'm Jer Stays.
And I'm Sven Gustafson. Take care of each other, and we'll get through this together.